Hello, my name is Stu Wisson and welcome to financialspreadbet.com. In this video I'm going to be talking through what the commodity market is. Now let's assume you're biting down onto a lovely bar of chocolate. Nice, isn't it? Chances are the company that makes that chocolate has made millions of bars of chocolate all over the world. A good example is Cadbury. But have you ever thought how they secure the price of the cocoa that is used to make that chocolate that you're eating right now? Now many food products contain soya too. What about the cotton that makes the shirt or blouse you're wearing? Or the orange juice that you're drinking in the morning? Now how do large manufacturers maintain price future stability in products that they make? The answer is in the commodities market. The commodities market covers a large and developing list of physical products, foods, electricity, metals, oils, gas and so on. Initially the commodity markets was strictly for agricultural purposes. This was sprung from the development that ensued over the world in the 19th century, with the transportation becoming easier and farming on larger scale allowed for more wholesale pricing of common agricultural items such as grains, pigs, cattle and so on. Now a means of trade had to begin, which was the foundation of what was the commodity market as we know it today. And however, the modern commodity market contains a greater array of products way beyond that of just agriculturally produced items. The commodity market, much like the other financial markets that I've been discussing, does have a good degree of duality. By that I mean it serves its true aim as to providing a means for companies to buy contracts to purchase or sell commodities, commodity items at a future set contract price. However, as with the dawn of computers and the rise of the ever greedy financial markets, there has been an increase in the amount of products that can be traded that are derivatives of the same market. Remember that a derivative is basically a product created that has no intrinsic value in its own, other than that of the outcome of the contract closing event of being true or not, and to what degree, based on the underlying product. Now, in fact, apart from the stock trading, those which has no ability to... In fact, apart from the stock trading market, which has no ability to short the market, in other words, make money when the market is going down. Now, when I was young, and my father invested in financial markets, all there was the stock market and the futures market. Now, the futures market back then was focused on the commodity prices, the underlying, but this same market is what companies used to secure the sale of purchase of commodity items. Now, I remember looking at around 16 years old at the promotional material my father received from his broker about the futures and options market. Now, it took me a long time to understand how it worked. I simply couldn't get my head around that you could own something but never take delivery of it. You could trade it but only have to pay a fraction of the amount you were buying or selling, and if the market moved in your favour, you would make money. Now, in many ways, many people, even today, do not understand truly how the markets work, and that most trading these days are based on derivatives. Very few actually take delivery of the item they have a contract for, which is a good job really, as when I did trade futures and options, option to buy, call or sell, put, I had little experience and did so not really knowing what I was doing. In fact, if truth be known, I was petrified of having a contract go to expiry, as I imagined very early on, I hasten to add, that I would end up with several tons of pork belly meat on my doorstep. Needless to say, my moment trading these was very fleeting, till I found financial spread betting. Now let's take a look at the commodities trading methods. Now there is spot trading, which allows for the delivery of the commodity to be taken immediately or soon after the transaction has taken place. In other words, on the spot. The commodity market does have a lot of standards, so inspection is never required or rarely required because all the products that are delivered must meet certain standards. However, if inspection is required, then the buyers or sellers cannot market on the commodity market and must use the wholesale market. Now, the reason for spot trading exists is it basically allows for a manufacturer to purchase additional product for an immediate use. Say, for instance, if demand for a certain item they are manufacturing is outstripping their current supply of whatever. Then the company in question will use spot trading to purchase more at the current market price. Next, we have forward contracts. Now, this is a contract between a buyer and a seller where the price of the commodity item is agreed on the day the contract was created, with a fulfillment date in the future. Now, standards vary and samples of products are usually taken to agree a price and a future delivery. And then the more common are futures contracts. Now, this seems almost identical in terms of the forward contract, in that there is a contract between the buyer and seller to agree the sale and purchase of a commodity at a fixed price fixed today, with the delivery in the future. However, there is a key difference, is that forward contracts are an agreement to deliver, and the amounts of commodity agreed in the contract, and the contract is always fulfilled, always fulfilled. In other words, the 100 tons of belly pork is actually delivered. Whereas with futures market contracts, the amounts, grade, standards and so on are preset by market standards and delivery. So most futures contracts are never fulfilled. It's simply the trading of these contracts that allows for speculation on the commodity market. However, you can, of course, take the option to purchase the contract to fruition. Now, finally, we have hedging. Hedging in the commodity markets allows for groups of suppliers to form a cooperative to ensure against poor yields of their commodity through the use of futures contracts in the same commodity in which they supply. Now, therefore, allowing them to hedge any risk of a poor yield through the ability to profit from that of taking a speculative trade in the futures market. If the supply of the commodity they produce is in short supply, then the futures market for that commodity goes up in value, and therefore the cooperative can still profit with a poor yield.